Hello, and welcome to another and important episode of The Laughing Retirement. Today, we're going to talk about probably one of the two most important subjects that you're going to need to tackle if you're really interested in moving to Italy. Now, why do I say that? I say that because when you go to Italy, you've got to have a visa if you're going to stay more than 90 days. And the second thing is, if you want to stay more than 183 days in a year, you're going to owe taxes. So we have a rather special person with us. And I hope I'm saying this correctly because it's terrible to introduce somebody and say their name wrong. Christian Gulizzi. Did I say that right?
Yes, you did. Christian
Thank you.
Gulizzi.
I'm going to introduce Christian Gulizzi. And I have him with me today because he's a rather unique commercialista. And that's commercialista is kind of Italian for CPA. And I'm going to ask Christian, please, will you tell us a little bit about yourself and what you do that is so special?
Absolutely. First of all, Chip, thanks for having me as your guest today.
My
So
pleasure.
my name is Christian Gulizzi, and I was born in Italy, so I'm a full-blood Italian, even if part of the family is German. So my story goes like this. Basically, I become a German Steuerberater and a US CPA pretty much 10 to 12 years ago. That was the time where I started working in these fields and got licensed. And later on, I also decided to do the Dottore Commercialista, which is basically the corresponding exam to the US CPA. And to do so, basically what I did is I was living in all of these countries, Italy, Germany, and the US. So I've also been 5 years in the US where I then did my US CPA. And I've been working now for the last 15 years in helping out US citizens and other international folks that travel around or live in different places to tackle their tax obligations when they have cross-border transactions. And so what I typically do is, and what's unique about myself is that because of being licensed in these countries, I can help my clients on both sides of their tax obligations, meaning that if a US citizen moves to Italy, for instance, I'm able to help this person on the tax side from A to Z, both on the US side of things and on the Italian side of things. So I can prepare both tax returns, tell you which tax due dates you're going to have, and helping you out with payments and obligations other than just the tax returns, also other ongoing tax obligations and what one can have in a country. And and that's pretty unique because typically Americans that move to Europe or other countries will encounter this difficulty of having to work with two different CPAs. Most of the times you see a lot of errors in their tax returns just because those two persons don't talk to each other. So that's the unique part
You don't have to worry
of
about talking to somebody else, do you?
Yeah, typically not. But so many clients that come to me for the first time, but having lived in different countries already, tell me this experience. Basically, they say, we have been looking for someone like you that can do both parts of our tax obligations. And it means that you just have to provide all of your documents to one person looks at it. And I typically prepare the returns basically at the same time. It's like having one part of the monitor with the US tax return open, one other of the monitor open with the Italian or with the German tax return, depending where this person's live.
Is there any problem with the fact that in the United States they're due on April 15th, but in Italy they're not due on April 15th, they're due at a different time? How do you work with that?
Yeah, that's exactly what is special is that basically in April I need to start thinking about, okay, is there any obligation on the US side? So I need to basically anticipate what's going to happen on the Italian side when it's time to calculate the taxes. So typically I need to start working with US citizens that come to Europe already around February, March to start gathering the documents, start setting up a preliminary draft of both returns, and to double check if this US citizen needs to make any payments by April 15, because that's typically the payment deadline of any tax due on the US side. The filing deadline for US citizens abroad is automatically extended to mid of June. That's when I typically try to complete the tax returns, both the US and the Italian ones. And then the payment deadline in Italy is typically June 30th, when it comes to the
Okay.
basically final tax payment. Italy also has a system of prepayments or estimated taxes like the US has, with two deadlines, typically same June 30th and November 30th. And yeah, so we deal with this timing difference or timing issue, but because everything is being done from one hand, basically, it's easier to deal with it as if there were two CPAs involved, because then the US CPA would be asking already a lot of questions in April that are not available yet.
And I just learned something. I just learned that for the U.S. citizen living abroad, he's got an automatic extension to the 15th of June, and that's a big deal, and it helps you overcome that April 15th filing date when you get an Italian tax deduction for paying overseas, but technically you might have thought you had to pay it on April 15th, but you don't. So that is helpful.
Yeah, so always remember that the automatic extension is a filing extension, not a payment extension. If for some reason a US citizen ends up owing taxes on the US return, then the best advice is to try to make that payment in April to avoid any interest charge from accruing. There's no penalties through June 15, but there could still be interest, which can be relevant depending on the amount of tax due that you have.
Okay, that's important. Let's talk about something else. Americans are always concerned with paying less taxes.
Yes.
And I don't suppose that's unusual anywhere, really. But Italy does have a 7% flat tax offer for people who move into, and let's just say, the southern part of Italy. And I have a list of where, and there are certain towns in Lazio, I believe, certain towns in Umbria, so, and Abruzzo is in there. So would you describe the advantages of the 7% tax?
So the advantages of this regime mainly boil down to not only a lower tax rate than you would usually be exposed to in Italy, but also a simplified way of filing and reporting your financial information to Italy. Because the 7% regime is basically a simplified tax regime where Italy says we are going to tax your worldwide income that you receive from foreign sources at a flat tax of 7%. We don't necessarily want to know each single item of income you're receiving, because when we actually fill out the tax return, is one number that goes into the tax return for this kind of regime. They want to know your total foreign income, and that's going to be taxed at a flat 7%. So it's a very simplified way of reporting your income to a government, and it excludes some of the harsh requirements that people may be exposed when having foreign assets. So let's say you have foreign bank accounts, foreign investments back in the US when you move to Italy. Typically, a person that is taxable in Italy would have to report those and pay wealth taxes to Italy. It's called the Quadro RV, like the RW series form, and where you have to list all of your foreign financial assets. That thing is excluded or exempted if you qualify for the 7% regime. So those are the main advantage: lower tax rates, a simpler way of having to report your income, so less work for both, yourself and your tax accountant, because we know we don't have to fill out 10 different forms, but we have to put one number into that box. However, it's very important that that number is correct, because there's rules that say if that number is not correct, or if you're underpaying your 7% tax, then you may disqualify completely and retroactively from the regime.
Well, that makes sense. Now, you said all income. So all income includes Social Security and includes anybody's pension and includes a U.S. pension, an Army pension, whatever it happens to be?
So the first thing that is important when I say all income is foreign source income, which means only the income that is coming from abroad. So if you were to move to Italy and work in Italy or do some work or some part-time job from Italy, then that part of the income does not qualify you for the 7% regime. So the only income that is subject to the 7% regime is foreign source income. But Chip, rightly you said, we need to first check whether a certain payment is even taxable based on Italian law. It doesn't mean that everything is going to be subject to 7%. There could be a payment like a US disability pension, for instance, the disability benefit, that would already by definition not be a taxable payment under Italian tax law without even looking into a tax regime.
Okay, so there are some things, some income that even under the 7% rule are excluded.
Yes, an example could be if among your sources or income, there's a so-called public pension, which means more a government pension. An example would be if you're a veteran or an ex-military member or a government employee and you receive a specific public employee pension, then those are typically taxed only in the country that is paying this pension.
Okay.
So that could be one exception. Obviously, if that's your only source of income, that may mean that you cannot qualify for a 7% tax regime because technically you're only allowed to enter the 7% tax regime if you have some sort of a taxable payment
Outside
that qualifies you. Correct. So
right.
you may be able to exclude it if it's a secondary or a third kind of stream of income that you have. But if that's your only source of income, you may want to relinquish basically claiming the treaty exemption if you want to absolutely enter the 7% regime.
Okay, so and you can help people with that to make that decision.
Absolutely. Every time I do onboarding for my clients, we have initial conversations, and the first thing I'm going to ask is, tell me about your income. Maybe you can provide me a list of your income or a simple Excel sheet where you list all of your income and assets that you expect to have, own, and receive while you will be an Italian resident. And then we can do an estimation of income taxes due to Italy and what item is going to be taxable and what item is not going to be taxable.
Okay, now there's a huge confusion, and we have a lot of subscribers here, and one of the questions I get all the time was, well, my government pension is Social Security. And if I'm listening to you properly, you just said that Social Security that we receive from the United States when we retire somewhere between 62 and 70 is not a government pension.
That is correct. What they intend for government pension is basically a pension that an employee receives from having worked for a government body. That's why I was saying before, for a typical example of Americans moving into Europe is maybe veterans, ex-military members, or people working for government agencies, public State Department, professors at public university, all these kind of pensions that are really coming out of these specific government funds, not coming specifically from Social Security.
Okay, so you just said a professor from a state university. In other words, University of Pennsylvania, University of California, et cetera, but not if you went to, say, Florida Southern College, and it was not a state university, it was a private university, so that would not qualify.
Correct, because that would be considered a private pension for a private employer or earned while working for a private employer. So that would qualify under international rules as a private pension. So, and the difference is when it comes to taxation is that typically public pensions tend to be usually only taxable in the country of the payor, meaning the country where the pension is being paid out of, in this case, the US. And while private pensions are typically taxed in the country of residence. So Social Security pensions, the typical Social Security pension that someone that has worked in the private sector and has paid into Social Security and receiving their Social Security pension at a certain age, these are considered private pension from a tax treaty perspective. And that's why basically it's always said, private pensions are taxed where the person is actually living, the country of residence, while public pensions would be taxed in the country of source.
Okay, that's a big deal. Now, another thing that we've run into a couple times is somebody who moves to Italy and establishes a residence, and let's say up north, and then they want to move to the south and get the 7% rule, but they decide they don't like that, so then they move somewhere else. Can you hop around and still pick up the 7% rule because you just moved to a 7% area, even if you didn't stay? How does that rule work?
Yeah, officially, it's not allowed to officially move in one place. So take up residency, walking to the Comune of Milano, for instance, a big city in the north, and then change it to a residency in the south. That's not going to work. So the 7% tax regime rules require you to basically, the first residence that you pick up needs to be in one of those comune that have less than 20,000 inhabitants and in certain regions.
And so, you need to stay there.
You need to either stay there or you can switch between those communes that qualify. So if you're in Abruzzo, in one that is less than 20,000 inhabitants, but later on you decide you want to move to Sicily in a 20,000 or below inhabitants town, you can do that. So you can switch between the communes that qualify for the regime, but once you go out, you lose the benefit prospectively. And if you were to initially move to another town that is not under the 7% regime, then you have basically no chance to get into the system. So this obviously doesn't mean that a US citizen who's moving over to Italy is not allowed to set foot somewhere in the north for a few weeks while looking out for opportunities or where to go into Italy, because taking up residency means that you need to officially register at your comune, or at least really have a rental, a home or something in another region that doesn't qualify for the 7%. You can do so at the beginning, but the important thing is you cannot basically ask for residency there, because then that would mean, okay, you have the intention to stay in a town that is not a 20,000 inhabitants or less.
Okay. Okay. Are there any other rules? So this 7% regime is designed for somebody just moving to Italy. Now, can they apply in the second year or the third year, or does it have to be applied in the first year as long as they are in a place that qualifies for the 7% rule?
So the election can be made on an annual basis. It means as long as let's say that someone wants for some reason to do it starting the third year instead of the first year, then the only requirement to be allowed to make the election in the third year is to basically have not moved to another comune that does not qualify for that. So let's say you move to a small town in Sicily, and for some reason you decide not to apply the regime in the first and the second year, there's no rule that prevents you from applying for the first time in the third year. So I would say that's not a problem.
Okay. But somebody like me who moved here 7 or 8 years ago before the 7% rule existed, I couldn't just opt in.
Well, the point is that you moved into, and the first question is, did you move into a town that had that would qualify under the 7% regime?
No, I moved into Rieti.
Yeah. So there's no option to for those people that moved before that, because that wouldn't because it's meant to be for moves after 2019, because that's when the law has been introduced. So there hasn't been a provision. There hasn't been a provision that says for people who moved there prior to that date, there would be this option. So I would say no.
Okay. Now we've talked about some of the advantages. We've talked about why this can be less expensive. Are there any disadvantages to this 7% rule that you can think of where somebody might not want to opt in? Are there disadvantages?
The disadvantages are less common. So depending on the exact type and nature and amount of income that the incoming person is making, and the sources of this income, it could make sense to not apply the 7% regime. An example would be if you have income from multiple countries, you may want to maybe just do the 7% regime with respect to certain countries. That's an election that you can make. You don't have to apply it to all of your countries from which you're receiving foreign sourced income. So an example, and I have a few of those in my clients, is when you are receiving income from multiple countries, and for instance, you're receiving rental income from one country, then the issue that happens is that you pay typically tax in the country where the real estate is located. So let's say someone has a home in Canada while living in Italy, coming from the United States. So in Canada, you'll keep paying taxes on that rental property because the real estate is located in Canada. But in Italy, they may also want to tax that income because it's foreign source income. So it would be subject to the 7% tax. However, the taxes that you pay in Canada are not creditable under the 7% regime. It means that because it's a flat tax system, they don't allow you to use the foreign tax credit in Italy on foreign source income. So in that case, you may want to opt out from taxation from Canadian source income in Italy, which would allow you to fall under the ordinary taxation system, but claim a tax credit. So let's say you would be paying 23% taxes on that income in Italy, but are paying 35% taxes in Canada, then you can avoid taxation in Italy completely by claiming the foreign tax credit. But you can only do so if you opt out from the 7% regime for that specific country.
Okay. Well, I'll let you explain that to somebody who has the problem, because this gets kind of technical. Now,
another disadvantage that I may tell you from what you were asking me before, let's take this example again of a US citizen that has just a government pension. And that government pension would, by definition, be taxable only in the US, not in Italy. So a person that only has that stream of income may not have an incentive to use the 7% tax regime because that person has no taxable income in Italy. So sometimes clients come to me and say, I'm an ex-military, that's my only pension I have. I just have a few bank accounts and small investments. So I tell them, okay, it probably doesn't make sense to opt into the 7% because then you have to make your government pension taxable and relinquish any treaty benefits. So there's no benefit, because if you use the ordinary system, that tax item or that pension will not be taxed at all. And the only thing you may need to do is reporting your foreign assets on the RV series schedule. And but that's not going to hurt a lot. If it's just a bank account or some small investments, it's not something that's going to hurt. So it may be more beneficial instead of paying 7% on your tax-free government pension.
Okay, I get it. All right. Now, we've learned a few things today. Number one, Social Security for most of us is going to be taxable.
Correct.
It's not always advantageous for some people with a single stream of income. It's not always advantageous to opt into the 7% rule. Oh, I know a question I get all the time. Is Social Security disability taxed?
So
we have something called SSI, which if you qualify for it, means that you qualify for kind of an extra pension from the United States government because of your disability, but you may not have worked for the government.
Yeah, so if it's coming from the Social Security Administration, that's the question that you would have to ask from a US perspective when you look at it. If it's coming from a Social Security Administration, then Italy basically says if it's comparable to a state disability pension in Italy, then it wouldn't be taxable. So in that case, we wouldn't even go into the tax treaty and check what the tax treaty says. We would just work with national tax law and say, okay, this kind of payment resembles what a disability pension would be in Italy. And Italy has a rule that says disability pensions, by definition, are not taxable.
Are not taxed. Okay.
So in that,
Okay.
even if it's a foreign disability pension, you would not have to report it.
All right. Now, what is, we've been talking now for about 30 minutes, and I want to make sure that people know how to reach you. So if you can give me, number one, your phone number, number two, your email address. If you can give me those two things, we're going to put them down at the bottom of the video so that people can reach you for your consultation. And Christian and I have been around this before, but because of Italian laws and Italian ethical laws, Christian cannot say, here's how much I charge. Done. He has to look at each case individually and say, here's your situation. Here's what I charge. Here's the reason. And so if I know sometimes I've been asked, well, how much does the commercial lease charge? Well, it's not exactly that simple. And so because he's doing multinational taxes, it's not always straightforward as it may appear in the United States. Oh, there's one other thing I want to bring up because this happens all the time. I got a note from somebody who lives in New York and they're interested in moving to Italy and they were asking about taxes. I would suggest that anybody living in a high state tax state, New York, California are examples. New Mexico is another example. There are multiple states which I would say are high tax states. If that is the case, I would highly consider moving and establishing residency in a low tax, no tax state, Kentucky, Texas, Florida, I think Washington State is another example. So because the state taxes follow you, don't they, Christian? You have to pay state taxes from the state you left in for the rest of your life. And so eliminating that tax makes a lot of sense.
So yeah, those high taxing jurisdiction in the US, they tend to be fairly aggressive in claiming that you have not left or ceased to be a resident of that state.
Been there, been through that.
Correct. In my experience, it's not always a matter of first moving to a state with low taxes. As long as your move to abroad is genuine, as long as you can say or show that you have basically transferred your domicile, let's say to Italy, and started filing taxes here, purchasing a house or getting a long-term contract for your apartment rental. As long as you can show these kind of elements that basically the center of your vital interest has transferred actually to Italy, which is basically the definition of domicile. Once you don't have a domicile in the state yet anymore, then typically in those tax audits, you're able to defend your position and tell those high taxing US states that you're not a resident anymore. Of course, it's a problem if you keep a lot of ties to those states, if you keep going back there regularly, if you keep a home available to you, if you keep a car registered into your name, if you keep a lot of assets there, that's different. But as long as you're doing a genuine move, you can decide on a case-by-case basis if it's really important to just first move to another state within the US. But many times it helps if you want to maintain certain ties to the US to then move to another US tax. And obviously, I need to say this as a CPA and a commercialista. These kind of moves need to always be genuine. Otherwise, you're not going to be recognized. So just setting up a mailbox in Florida won't be sufficient.
Well, exactly.
It needs to have some substance, and the move needs to have substance to be recognized by the other states.
And Christian is exactly correct. And I can use my own example. A lot of brokerage houses now will demand that you have a physical address. And a post office box is not considered a physical address. So when we left New Mexico, I moved my business to Nevada, where I established an LLC. but I moved my house and we have permanent residence in Montana, which is a low tax state. So we have a presence in the United States, which for investment purposes and for physical address purposes has not changed since we moved. So, Christian, I want to thank you. We're going to put your phone number and your email address.
Perfect.
It is so much easier to talk to someone who can do both your US and your Italian taxes, who knows the ins and outs, where you don't have to talk to two people. And Christian and I are going to be working together, and I hope that you will consider him along the way. And please, when you talk to Christian, make sure you say, I saw you on the Laughing Retirement. And Christian, we'll go from there. And I think the next thing we're going to talk about is Italian taxes in general.
Yeah, great. No, I'm really happy to do this. And yeah, so when it comes to contacting me, the best way is, I mean, I offer both ways, telephone and email. Obviously, what I always prefer is the first contact to be email. So if someone wants to talk to me about on the telephone, or if someone wants to have a Zoom call with me, typically I do the same thing that you offer as well with your Laughing Retirement. If someone wants to talk to me about taxes, I typically give a 20 to 30 minutes time window without any, requirements to sign up with me or pay any fees. So typically I offer my clients a free first-time consultation where we try to review the situation, and where I ask these questions I mentioned about listing income they receive, assets that they have. So the first step is always send me an email summarizing your situation, and then we set up a Zoom call, and then we talk about everything, and then we can see if we need to set up an additional consulting session, or if we can just go straight and file and prepare the tax returns. Yeah. Very quick question. Because you mentioned that it's not clear about the Social Security pension being taxed or not taxable. Is this something you have looked into yourself as well? Are you curious? Are you curious to hear my argument?
Yeah, you and I have talked about this. I went to a lawyer. Matter of fact, I went back to the same lawyer 3 times in Rome.
Yeah.
Who's a tax lawyer. And he said, no, your US Social Security is not taxed.
Because he would think that it's a government pension? Is that the reasoning?
I don't know what the reason was, but I can tell you that over 2.5 years, I went back 3 times.
Okay.
And he thought I was nuts.
Okay.
Because I kept asking him the same question, because I kept reading that it was taxable.
Correct. So again, just for our records or for the future, I mean, how I explain it to my clients is, okay, once you become a resident of Italy, all of your worldwide income is taxable. The Social Security pension is looked as a regular pension in Italy. According to Italian tax law, there's no differentiation between a private and a public pension. So in Italy, we have INPS, which is the corresponding entity as the Social Security Administration. So when an INPS pension is paid out, there's no difference of taxation on whether that pension is a public pension or a private pension. So from an Italian perspective, that US Social Security pension is going to be treated the same way an INPS pension, a regular pension that anyone who has paid into the Italian system receives, the same way, which is ordinary taxation. Then the next step is to check.
Wait a minute. So when an Italian citizen receives his pension that he is paid into, he is taxed on that?
Yes, because he has deducted the contributions. So the contributions to INPS, to the Social Security system, were deductible at the time that he paid the contribution. So basically,
you see, that's interesting, because I've been self-employed almost my whole life. There's only 3 years in which I worked for somebody else. And in the US tax system, when I paid in my 15%, half of it was deductible. Correct. The other half was not deductible.
Correct.
But now I'm paying taxes on the whole thing.
Well, you're not necessarily, because if you're making under a certain threshold, if Social Security is your only income, you may pay nothing.
You may pay
If you have
nothing.
additional income, you're only paying on 85% of it, because there's this
Okay.
85% rule. So it actually is in line with the system. And in Italy, you can deduct 100% of your pension contributions. That's why 100% of the pension later on
Of
is
the
going to be
pension will is
taxable.
taxed. Okay. I get you.
So
All
that's the
right.
first step. And then obviously, why do people get confused? Because people start going into the tax treaty and start mixing things up, because they think, oh, is this a government pension now? Is this a Social Security benefit now? What is it? But the Italian and US tax treaty are clear on that. If you go in Article 18, paragraph 1, where it's about private pension, is going to always say that it's taxable in the country of residence only. So if you live in Italy, it's going to be taxed in Italy only. But that's from an Italian reading perspective. Same thing with paragraph 2, that has the wording with Social Security benefit. Also, these benefits are technically only taxable in the country of residence. But what many Americans don't know is that there's certain limitations on how a US citizen can apply the tax treaty, meaning the savings clause. If you go into Article 1, paragraph 3 of the tax treaty, you will read that there's a long list of exceptions as to whether you can claim a tax treaty benefit as a US citizen or not. And believe me or not, you cannot claim a benefit for those pensions. So those pensions that fall under under Article 18, paragraph 1 and 2, which means based on the treaty, both countries are allowed to tax Social Security. So a US citizen living in Italy will have to report Social Security on his US tax return and on the Italian tax return. And now you're going to ask me, Chip, how do we avoid double taxation on this? Double taxation is avoided by claiming a procedure called resourcing income by treaty on your US tax return, which means you now are allowed to claim a foreign tax credit on an income that is actually US sourced based on this treaty rule. So most of my clients that are in this situation, US citizens moving to Italy with a Social Security pension, you have to report it on your Italian return, pay taxes in Italy, be it 7% or be it the regular taxes, depending on whether you're in or out of the regime. You have to report it in the US as well. But in the US, you need to fill out a Form 1116 foreign tax credit, where you claim this treaty position that allows US citizens who live in Italy to avoid double taxation by claiming a foreign tax credit. So the US will grant you foreign tax credit for the taxes that you have rightfully paid to Italy, because Italy has the taxation right based on the treaty. Is that understandable?
Yes, it is. As a matter of fact, that was the clearest thing that I have understood since I've been here in 7 years. And Christian, I will be talking to you soon. Obviously, I have to send in my taxes, so I'm in the same boat that all of you guys are. All right.
Yes, wonderful.
Thank you.
Perfect. Bye.
Thank you very much. Bye-bye.
Bye-bye. Bye. You're welcome.
To close this out, this was a fascinating session in which I heard some things and learned some things that after 7 years I didn't know. And after 7 years of having received conflicting information, I finally have something that I can base it on and base my taxes on, and something I understand. So as far as the Laughing Retirement is concerned, on July 20th at 11 a.m. Eastern Time, we're going to have a masterclass on U.S. taxes and how to lower your taxes in the United States. Everybody is interested in how to lower taxes, but if you're drawing down your IRA, you're never going to do it. It's never going to work, okay? I can show you how to save well over $100,000 in fees and lower your taxes from the 22 or 24% bracket down to a 12 to 15% bracket. And we'll show you how to do this using the perpetual income engine. And I hope you'll join us for that masterclass and for some new videos that we have coming up on the Laughing Retirement. As always, I'm Chip Stites. Email me if you have any questions at info@thelaughingretirement.com. and just put question in the subject area. As a matter of fact, this particular video comes out of a search for a long time that I tried to find the right person to talk to. For over 3 years, we've been looking, and I think Christian's the guy. And I think you will want to talk to him. So again, I'm Chip Stites. This is The Laughing Retirement, and I'll see you on the 20th of July at 11 o'clock Eastern Time for a masterclass on how to lower those U.S. taxes.